When searching for a mortgage, consumers will see a variety of mortgage rates offered for each different type of mortgage product. While these may be average mortgage rates being offered, the real interest rate that a borrower will receive will depend on several factors that are part of their individual mortgage application. The type of mortgage program and the length of the loan are the most well-known of a number of items that determine mortgage rates. Many borrowers choose to pay points, which is the easiest way to reduce the mortgage rate. By doing so, the interest is paid up front and becomes part of the closing cost. In some cases, when a borrower chooses to have the lender pay part or all of the closing costs, this action will increase the mortgage rate. The credit report is the starting point of the mortgage application and will have an impact on the mortgage rate. Borrowers who have a high credit score, usually 720 and above, will be offered the lowest mortgage rates. The borrower's debt, as shown in the credit history, is also considered when comparing it to income. As the debt-to-income ratio gets higher, so does the mortgage rate. The property type is also another factor and has a direct effect on the mortgage rate. While the lowest rates are for single-unit primary homes, rates for investment property, rentals, multi-units, and sometimes even second homes carry a higher mortgage rate. Loan amounts, both low and high, will also help determine the rate, but not the way most people would imagine. Lower loan amounts often have higher interest because there is a certain amount of profit that is expected to be made for each loan. At the other end of the spectrum, loan amounts above the conforming loan limits, known as jumbo mortgages, also have higher mortgage rates. Equity in the home and down payments are also considered risk factors and will have an effect on the interest rate that is offered to a borrower. Large down payments or equity will have lower mortgage rates since there is less risk. On the other hand, the higher the loan to value, the higher the rate. Mortgage rates can be locked in for 15, 30, 60, or 90 days, but each length of time affects the rate. The longer the lock period, the higher the rate will be. The loan lock period must be considered very carefully because in most cases, a rate lock extension can also cost the borrower. Although this may sound confusing, these loan scenarios are presented on rate sheets to which loan professionals refer to in order to give the borrower the true and accurate mortgage rate that fits their personal loan application. For this reason, borrowers will find their mortgage rate is often different than someone they know.